What if playing it safe is the riskiest move of all?
If you only do the super safe deals, great, you're gonna do 1.5x fund, amazing. That's not exciting for anybody.
While Silicon Valley chased growth at any cost, one European investor discovered something remarkable hidden in the numbers.
2/3 of the companies in our second fund are bootstrapped, meaning they reach 10, 15, 20 million of AR without ever raising institutional money.
But what does true efficiency actually mean?
Efficiency is the ability to invest your cash from operation as a scale-up into something you're going to do at a high rate of return.
The data tells an incredible story.
If you look at the ratio ARR per employee, in Europe, if your company is around 120K of ARR per employee, usually you're going to be breakeven. In the US, twice as that, 250. So it's crazy.
Europe's supposed weaknesses, regulation, fragmentation, capital scarcity, have forged an unexpected advantage.
We can't say that the heavy regulation and the fragmentation of the European market is a positive. But for those companies and those founders who manage to emerge and succeed despite that, it shows a level of strength, competitivity, that is well tapped.
And now, a new generation of founders refuses to settle.
We are going to build a world-class business. We're not going to settle.
How did Europe's constraints become its secret weapon for building global champions? Join us for this episode of the EUVC Podcast with Omri Benayoun from Partech, where measured risks and disciplined efficiency are reshaping the rules of venture capital.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC's innovation banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, SkyTech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to SkyTech this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome back to another episode of the EUVC Podcast, where we connect and champion the voices shaping European venture. Today, we're diving into the forces forging Europe's next generation of global champions, and joining us is Omri Benayoun, General Partner at Partech, one of Europe's absolute premier investment platforms. Omri has been co-leading Partech Growth equity strategy since 2014, with 2 funds adding more than 1 billion euros. When not investing, he's a family man, an amateur chess player, and a rock climber. We need to talk about that because I want to go rock rock climbing in nature. So, but then let's get into this topic of today. We'll explore the region's capital efficient DNA, the role of elite capital allocators, and how Europe's complexity can also be a strength in building resilient global tech leaders. Oh my God, that was a big one. Did I get some of that correct around who you are?
Yeah. I mean, all correct, absolutely, and very happy to talk about rock climbing as well.
Let's just touch on rock climbing. So, curveball here, right from the beginning. What does rock climbing give you as an investor as well?
Yeah, look, I picked this up 5 years ago, so I'm a recent convert. It really started out in nature because you have rock climbing in the gym, but in nature, and I really started in nature, and it's about expanding slowly your comfort zone and taking measured risks. Because when you are, at 200, 300 meters up a cliff, there's a rope, the gear is good, but, you still have this fear. And so how do you live with the fear and go beyond it? That's replaying with this emotion that's been the biggest thing for me.
Have you had any, I wouldn't call it near-death experiences, because your wife or partner or whatever you have listening in would probably be like, don't talk about near-death experiences. Of course, my husband doesn't have that. So, but tell me, have you had any experiences on the mountains where you looked danger right in the eye?
So when you rock climb, you fall. Not everybody is Alex Honnold, so does free solo where if you fall, you're not there the next day, but you still fall. And I mean, it's scary stuff. Once I was in the south of France near Aix-en-Provence, and I was, like a spider, 6 meters, just in the void. And so then your partner helps you come up. And for sure, it takes a good, 15 minutes to get back into the shape to keep going.
Do you get that when you fall? Do you get that life passing by slowly, or not at all?
No, it's very fast. Your heart is there, boom, and I mean you're not exactly yourself anymore, and then it comes back quickly. And
how often do you fall?
Less and less.
But should you expect as a rock climber that if you go for a 2-day stretch, you should expect to fall at least once?
Yeah, I mean, my teacher encourages falling. If you fall, you realize that it's not so bad. You can come back up and go higher. So if you're investing in metaphor, if you only do the super, super safe deals, great. You're going to do 1.5x fun. Amazing. But that's not exciting for anybody. And so from time to time, you have to do a bit more risk in a controlled fashion.
Incredible. We got to go climbing. We got to do a climbing. So we do treks in different places of Europe, and I've been wanting to take a group climbing as well. So we're actually going to the Alps in September, just a small group. So maybe we should talk about that. So Omri, enough about climbing. I want to ask you about your background because it spans government, corporate strategy, M&A, and operations, and now you're then co-leading Partech Growth Fund. I'd love to ask you what this multi-sector experience has done to shape your investment approach.
Yeah, no, absolutely. Look, before becoming an investor, and it's been 11 years that I do the same thing, I was a very unstable person. And so I was changing jobs every, 3 years max. And I've done different things, and that I think have been all so much useful to what I do today. If I do from the latest one to the earliest one, I was co-CEO of an e-commerce firm called cdiscount.com from 2012 to 2014. Billion euro revenue business, selling non-food items, mostly in France, competing with Amazon. And I think this has really taught me something that I use every day, which is how a real company operates. From the investor perspective, you can think that everything is all PowerPoint and Excel, but the hard life of managing people, of competing with the best in the world like Amazon, as far as I was concerned, of having your website go down during the Black Friday week, and you have just minutes to get it back up, otherwise it's a catastrophe. So I've lived through this, and I think it probably gives me more empathy than your average investor on what can happen to founders as they scale their business.
Tell me just before we go on to the next thing, cdiscount.com, where are they today? And I ask you this question because $1 billion revenue is in no way negligible, right? That's a huge company. And one thing that I find about Europe is that we don't know the champions in each ecosystem, and that's wrong. We're making we all know the big behemoths in the States. Same thing on the venture side. You can ask who are the top 10 firms in the US, and everyone can give you 10 names. In Europe, most people stop after 5. So for that reason, let's just touch on cdiscount.com. Where are they today and kind of what's happened?
I haven't checked the numbers recently. I do think that unfortunately, the past few years since COVID have been tough. As we know, for all e-commerce, COVID has been great, but growth has been so fast that a lot of things broke. And when demand fell off a cliff for most of e-commerce, and you had some bottleneck issues in supply chain stuff, it's been harder. So I don't know exactly where they are today, but definitely something that I was really impressed when I was there is the quality of the teams. To be able to get to that scale and competing with arguably one of the top 3 companies in the world was amazing. And it was a company that was very much under the radar back then.
Okay, then let's go to Casino because you led strategy there.
Yeah, so that was interesting. Casino was still is by the way, a food retailer with operations spanning from France to Brazil, Colombia, Southeast Asia. And it's a group that was led by a finance genius, if you will, who started out as a finance folk and that did an LBO on Casino and then became an operator. And then a lot of the international expansion, especially, but not just, were basically M&A, where he was operating the group as a whole as his portfolio companies. Because synergies between the biggest retailer in Brazil and the biggest retailer in Thailand, very slim, really. And so here I learned from arguably one of the brightest minds in France what it could look like to be a majority shareholder. As of today, with the growth fund at Partech, we only do minority, or at least we mostly do minority. Only one deal over the past 10 years was majority. But still, it taught me something about what is it to be a good board member, to be demanding, but not too much, something like this, I guess.
Yeah, let's just touch on that because I do think it is, I've seen it as well, much smaller scale, but I've definitely seen a majority shareholder realize, we got to move much closer to the business than hire in a chairman of the board that was miles above what you'd expect for this size of company, but then went in and was extremely efficient and effective with the leadership team of that company. And it was very interesting to see what it does when you have talent that is ranks above the business, so to say, caring deeply about the business. And I think that, I won't speak about Casino here, but I do think that that's a bit what you have when you have these outlier shareholders that just have seen and done it all, incredible minds and brains and networks that are uncomparable to anything, go in a series of businesses and just work their magic.
Yeah, and absolutely, that totally resonates. Something that I was really impressed by is back at Casino, you had some seasoned retail bosses of business units, people who had been on the shop floor and worked their way up, and they had so much respect for Jean-Charles Naoui in this case, because he was bringing something radically different, and he had this all-encompassing view. And yeah, totally, you could see how this combination, when it works well, can create magic.
Yeah, and I do think that is exactly why I also am so impressed by the VCs that create magic, because it is a bit the same, right? You come in with a toolbox that no one running an operational business could ever have in terms of network and insights and so on, and you can pull that and put that to leverage in a completely different way because you work closely with the founders. Yeah, so the power of an elite majority or minority shareholder is just very, very, very clear. Let's talk Dassault Systèmes then. Do I pronounce that correctly? And tell me about it. That's also another huge €50 billion market cap software company.
Yeah, so this is a company that no one is talking about in Europe, which I think is crazy. Because, €50 billion market cap in software, there's not so many of them. No. The company is a spin-off of Dassault Aviation, which produces both military jets and business jets. But it's a full software company, and they are the world leader in what they call PLM, product lifecycle management, but they are mostly well known for anything around 3D design, production, and simulation software. So I would say most of the cars, most of the planes, most of the machineries, boats, etc., you see everywhere in the world are designed with Dassault's product. And they started out with the design piece, and then they really expanding all along the life cycle of the product and also down in the data stack for product-centric companies. So you really have SAP in Germany that owns the ERP and all of the finance data, and we have Dassault for product-centric companies that owns the data around the product. And so, I was there for close to 5 years, and I was running corp dev over there, so strategy, investments, and M&A. And really, this is where I learned almost everything. This company is not well known because it's quite closed. They have their own culture. Almost everything is through internal promotions. And they have this very clear view of what they want to build, what is a software roadmap, where they want to go, how they learn from their customers. And this I reuse every day. Every day in all my discussion with SaaS founders, what I learned there about the clarity of a product roadmap, about how you listen to your customers, this is key. And of course, since I was doing M&A, I also learned there what I use now as well, which is how does the acquisition of a software company by a behemoth, how does that work? Typically, something that we talk with founders from time to time, if you launch a process because you want to do some form of exit, if you have not talked to these guys like 2-3 years before, and if you have not maybe done some form of commercial partnerships, never going to happen. This is not a fund that can react quickly, etc. For those big firms, it's really about a make or buy decision. Should I do it with my own R&D? Should I acquire this business? Different. So yes, it's something that's been useful.
I just want to challenge you to give me one reflection on what is an expression of the fact that we have a 50 billion euro behemoth that no one knows and no one talks about.
I think the ecosystem loves to celebrate the quick buck. So, the big fundraise, very fast, etc. And the companies that adopt a slightly different path, which is the painstakingly, somewhat slow building of a company that is going to be the world leader in this field, but it takes a bit more time, is less news. Dassault was profitable from day one, so they never raised money. This is, I think, a cultural thing.
And speaking of overnight successes versus, because I just did a bit of research, and Dassault Systèmes is founded in 1981. So you're absolutely right about. Yeah, it is a different, and we just, for whatever reason, take them a bit for granted and don't talk enough about them. All right, government. Then, so I am on a crusade to get VCs more involved, not in government necessarily, but at least in policy and politics. So I'd love to ask you, what were your reflections there? Maybe talk a bit about what you did there and how you're now thinking about this topic of VCs getting involved in policy.
So it was the beginning of my career. French engineer. It's a bit weird, but a lot of us back in the day, but still today, start by going to the government. I think you have the same thing in Japan, but in not so many countries in the world, whatever. And so I was for 4 years working for the Ministry of Industry and Finance, basically trying to support in different ways French SMBs, if you will.
Because I heard the other day someone say that they thought that maybe it would be a good idea for everyone to do a stint in government, either early in their career or later or something, but because it breeds a familiarity and respect for the system, so to say. But at the same time, it also, of course, brings in talent in a way that you don't normally. So maybe instead of doing military duty, we should do government duty.
I think that'd be great because it's important for civil servants and politicians to get a better view of what the economic society does every day and get a bit of this insight. And conversely, the world has changed a lot, if you haven't noticed, in the past 5 years, maybe 5-10 years. And I think up to 10 years ago, people could think that, the government was something that was in the background, doing its thing, but us, investors, founders could live our lives in a different plane, of economic happiness. I think history is coming back, right? War, COVID, policy, tariff barriers, etc., I am deeply convinced that investors and founders will have more and more to work with their own governments and other governments to succeed. We're not going to be able to just hide it and think that government is something for, other folks.
Let me hear your reflection on this. I heard Morgan Andreessen say on a podcast a couple of months back, he said, if you had told me 10 years ago that the largest arm within the Andreessen Horowitz platform would be their government or policy team, he would not have believed you. But it is today. What does that make you think? How do you think about it inside Partech? Do you do anything?
I am not the only one to have a government background. Actually, my partner in crime, Bruno Kremel, with whom I started the growth equity strategy at Partech in 2014, was even higher up. He used to be the chief of staff of the Minister of Economy in the early 2000s. So that tells you something about France, where a connection between the states and the elites is quite close. But it's something that I think France was probably, for better or for worse, slightly ahead of the curve of other countries because of this tradition of a very strong central state who want to project power also through its action in the economy. And so I think what we're seeing now is this is happening everywhere. When Trump is doing tour in the Middle East, and where one of the big takeaway is the investment in AI is projecting power through state means of the economic sphere of all AI companies. Every country is going to do this more and more, and so I don't think as investors we have a choice to stay absent of this. This is to the service of our LPs and to our founders.
Are you willing or able to share anything concrete that you have done or are discussing inside Partech with respect to this specifically?
There are two ways. First, we know founders, we know politicians, we can bring them together. So at least the politicians hear directly from the founders, whether their daily issues with regard to some regulation, stock option laws, labor laws, stuff like this. So this we do. And the other one is when it's a bit less the case right now because France is in a somewhat deadlock political situation right now. But when governments want to do laws that affects, especially the tech sector, often they would ask folks they know what they think if we have ideas. And yes, we've been able to contribute. Sometimes, they want to do this in a very open forum, and we're happy to do this. And sometimes they want to test ideas with us, and we would answer like everybody else, I would say.
With respect to the hearing from founders directly, one statement that I heard that resonated very well was that the problem is that in most countries, and especially in Brussels, the ICP of the people that are building laws there, so to say, is a farmer and his two children. And we really need to do everything we can to make that, create another ICP for them, which is the founder in Europe. And I think that that's a powerful narrative to use.
Now in every country, you have a sovereign fund that is really acutely aware of this. In France, you have this entity called BPI, in Germany, KfW, in the UK, BPC. And then you have EIF at the EU level. And those folks are much closer to the political echelon that we are at Partech. And they're also quite close to us and to our founders. And often they're also a very strong instrument in getting this proximity closer.
For better and for worse, and let's leave it at that. You've been a driving force behind Partech's growth fund strategy, and I'd love to ask you for that reason what gaps you see in the European market that really made you say in 2014, let's really double down and do a growth fund in Partech.
Yeah, I mean, up to 2014, Partech was really doing early stage investment with two different strategies. One seed, led by my partner Romain Lavaux, and one, let's say, venture, led by my partners Jean-Marc Patouillot and Philippe Colombin. And back then, what they did see is founders up to this point were sometimes happy to sell early, but they were starting to see more ambition. And more ambition sometimes meant, more fundraisers. And there were almost no growth fund in Europe back then. I think you had Highland Europe that was on this podcast not long ago, Kenneth Partners, and maybe that was it. But the demand from founders and companies was there. The supply wasn't. So some of this supply was brought from US funds, but we felt that the market was expanding and there would be demand for domestic growth capital. So this is why Bruno and I started the journey.
And then tell me, now in 2022, you did the second fund, which means that we have a third one very soon, I'm sure. So tell me about 2020. What were the reflections coming in to 2020? What had changed? What did you see that you needed to?
Yeah, 2020, interesting times, right? We all remember. I cannot say that there was a lack of capital in 2020. To some extent, there was probably too much of it. And so here we decided to go to a probably slightly less shiny, exposed part of the market. And with Fund 2, that we are finishing to invest as we speak, we really went after bootstrapped companies. 2/3 of the companies in our second fund are bootstrapped, meaning they reach 10, 15, 20 million of AR without ever raising institutional money. And here, this is the gap we saw. We saw that capital was going after the growth at all cost type companies, but that if you were more on a, say, 25 to 40% growth mindset, but with EBITDA between 0 to 20, you were not interesting for the VCs because if you're profitable, it means you have a problem in your head. But you were not interesting for the mid-market LBO guys because at 10% EBITDA, you cannot really leverage, you cannot even value it on EBITDA. So what can you do? And so we went decisively to this part of the market, not just right, but also this part of the market, and it's been good for us, and we're very happy of the founders who's backed with this fund as well.
It's a bold move to make in 2020. In 2020, almost everyone raised money to just pour more money into the fast-growing companies, not thinking about capital efficiency at all. What do you think made you and your partners build the conviction to double down on such a contrarian strategy for the market? Like 2020 hindsight, it was absolutely beautiful. But in 2020, I think everyone was like, why don't you just raise $1 billion and just plow that money into some scooter companies?
No, I think that's a good point. I remember people asking me, "So, are you going to do it?" Scooter companies, and no, we stayed away. Look, I mean, I don't know. You only realize in retrospect that what you did was different. It's not that we said we're going to do something different, but none of the 4 partners of the fund, so Bruno, who I mentioned, but also André, Andrew, and myself, none of us have been swimming in this tech investing ecosystem for decades before. We all come from a different background where basically we just filter out the noise and we only try to apply, I guess, what people in our ecosystem now call the first principles. We just look at the business. We look at the business. Is this a good strategy? Do you have the beginning of a moat? Are the unit economics excellent? And is the founder ambitious, but a good steward of capital? If we have all of this from pure bottom-up perspective, whether it's, we like it because if you can compound at, let's say, 35, 40% growth for a long time, you can make a lot of money. And this is it, really.
And it is beautiful. Let's talk a bit more about the capital efficient advantage of Europe. It's often being touted as a European strength. I'd love to ask you what you think the structural and cultural factors that contribute to this are and how you have seen it play out in your portfolio.
Yeah. So first, I think we need to define what efficiency means, especially because in the recent years, with this race to become profitable or break even, some people are starting to conflate profitability and efficiency. It's not the case. Efficiency is, and this is, I think, I will quote my partner, André, is the ability to invest your cash from operation as a scale-up into something you're going to do at a high rate of return. So efficiency is only that whatever investment you are putting in R&D, in sales, in marketing, you know that it has a high rate of return. And so we are very interested in this because this is how you create long-term shareholder value. So long-term value for the founder who, has when we invest in companies, they always have a large share of the cap table, and also for our LPs. So really, this is our focus. And the heuristic that now people use is this famous rule of 40, when you add the growth of the revenue with a percentage margin of EBITDA, which is a way to capture this trade-off, which I think that's kind of interesting. So yes, efficiency, super important. And why in Europe do we have an advantage? Well, first, I think for decades, Europe has had less access to capital than the US. And so decades after decades, culturally, European founders know, or in their lizard brain, that they would have to do more with less. It's something that we see typically in the Benelux market, where they even had a lot fewer VCs than other places. And so for us, we have in our fund 3 deals in the Netherlands, but we could have had a lot more because it's a microscopic view of Europe, if you will, in the Netherlands, even fewer venture capital. And so they do more with less, and they build amazing companies with no capital at all in the first place. So absence of capital creates constraints. Constraint creates inventivity, ingenuity, and you create a better company with this. So I think this is one. And the second reason why companies in Europe are more efficient is, as sad as it is, the fact that Europe is just a lot cheaper than the US. So when you look at a software developer in Europe, he's on average going to be paid half as much as in the US. And he's not half as smart, it's the same level, sometimes even higher. To build the same product, you need half as much money. And so I would say if you combine those factors, this explains why Europe has been, for a long time, and still is, a lot more capital efficient. If you look at the ratio ARR per employee, in Europe, if your company is around 120K of ARR per employee, usually you're going to be breakeven. In the US, twice as that, 215. So it's crazy. So it's really much different for the same company, the same size, etc. So it's good for Europe. It's a strength.
Let me ask you, any good cases from your portfolio on how this plays out?
Yeah, on efficiency, I think a great case is this company EcoVadis, that was in the portfolio of Fund 1. So EcoVadis is now the absolute world leader in ESG ratings for the suppliers of large companies worldwide. Think Fortune 5,000 companies. The chief procurement officers want to assess their suppliers, not just on price, lead time, quality, but also on ESG performance. Not because the government asks for it, but because the consumers, the customers, the shareholders, and the employees ask for it. We invested in the company in 2016. They were shy of 20 million of ARR and were bootstrapped, never as before. They are today, I don't have access to the latest numbers because we sold all of our stake to CVC and then General Atlantic and Astorg in the summer of 2022. So I'm not giving information that I shouldn't give because I'm not sure exactly, but I think they're around 200 million ARR. And the funny thing is, when we invested in 2016, there was half secondary, half primary, 15 million. When CVC invested in 2019, there was 17 million on the balance sheet. They had not consumed €1 of the primary. CVC invested both secondary and primary, and the primary was probably 50 million. And when G and Astor invested in 2020, on the balance sheet, you had more than the 15 plus 50 combined. So that's interesting. So that's quite both efficient and inefficient at the same time.
Yeah, I was about to ask you, what does that make you think about? Is that a unique story, or is it something you've seen play out and you've maybe thought about?
No, it's often the case. Look, bootstrap founders, they have developed this culture that €1 is very precious, and they will only invest it if they see a very good return. Now, an investor comes on board, they're not going to change, usually, you have different cases, but as a rule, they're not going to change everything, their way of thinking, the people they have hired to think like them, and the processes from one day to the next. And so they're going to start taking, a bit like my climbing metaphor earlier, they're going to start taking more risk step by step. And for the best businesses, when you start doing this a bit more risk step by step, it's not enough to really go down the J curve and burn all of this primary that you have raised. So EcoVadis, when we invested, they had to get to 20 million ARR, 5 salespeople. Not too shabby. It took a little time of discussion with management to start investing in more salespeople because we just saw that the payback was short, so we should just do it. But the payback was actually so short that we didn't need so much of the primary. But if there was not the primary on the balance sheet, the founders would not have felt comfortable enough taking these risks. So it's not like this cash on balance sheet was just a dead weight, finance folks, let's engineer it, put some debt, etc. No, because the founders will actually, they hate debt. They want peace of mind to make the choices. And the cash on the balance sheet is a way to have this peace of mind and to take risk. Sometimes, the case of EcoVadis, the risks they take are so good, the payback is so short that they don't consume the cash. Sometimes they do. But I think that's kind of an interesting fact.
Let me throw you a curveball. The fact that you, as Partech's growth investor, chooses bootstrap companies, how does that square with your early stage and seed stage investors in the family of Partech, and how do you discuss this inside the team?
Yeah, no. So look, Partech is an interesting animal, right? Because we have a seed team, a venture team, ourselves, the growth team, an Africa team that does both early and growth stage in Africa, and a newly formed early growth impact fund. All of this sits under the Partech umbrella, but everybody's autonomous. So everybody does its own fundraising, its own IC, its own exits. A good analogy is the analogy of the ancient Greek city-states. Everybody speaks Greek. They have a common culture. They speak to one another. When there's an enemy coming, they ally, they band together. When there's conquest to be done, they also go together, but they are different. There's different cultures. Sometimes there's a bit of friction, of course. Not as bad as the Peloponnesian Wars, but there's friction, okay? And that's it. Meaning we do our thing, the very capital efficient firms, whether bootstrap or VC backed. One of our biggest success in Germany is a company called Emboss. And Cherry Ventures and others had invested ahead of us, and we're delighted to be in this company. And it's been extremely capital efficient after our investment. And the latest round they announced, 250 million, was all secondary because no need for primary. The company is big, growing, and generating cash. So we do both. But our colleagues, they have their own strategy. What's interesting for each of us is we have a view very deep on a segment of the market. And so we can exchange this expertise. We can see what is happening here and there. And when I saw the amount of interest the early stage companies of my partners attracted in 2020, 2021, the way people thought the valuation people were ready to pay, of course that did inform our judgment that we should go somewhere else because we were not going to compete against SoftBank, Tiger and other folks. So, and at the same time, when they see what we like and what growth and P fund like in our companies, for some of their companies that have a financial profile that looks a bit like our companies, it informs them on how they should steer the company or advise their own CEO. So this is how we do it.
Kind of what's the rationale? What's the thing that you plug into the Partech family for as then an individual city-state within Greece? Why stay within Greece? What is the service that the corporate headquarters, so to say, offers to you as a fund manager that makes you say, makes sense to be here?
Yeah. And by the way, this is a question that all LPs ask all the time. And for us, the value is extremely clear. And there's different layers. First of all, the brand power of Partech is extremely strong, and the brand power together is much higher. This brand power has impact on LPs, which nowadays start to have a preference towards multi-strategy GPs. Also because, we are more solid in this market, we see more stuff, etc. So that's super important. There's of course some basic, process and cost synergies. Together, it's a lot more efficient than if each of us had to have it. And now on the front office side, we do collaborate a lot. Everybody has their own expertise. Like if you look at my partner, Reza, who co-leads the venture fund, he was one of the very early employees at VMware. He spent 20 years in the Valley in leading firms in product management, product marketing roles. He is, I guess, our expert in-house on everything infrastructure, software, and cybersecurity-wise. So when we see stuff with the growth equity fund, of course, we're going to go see Reza and, both pick his brain, put him sometimes in front of founders, and this helps. And conversely, when our Africa colleagues looked at a payment business in South Africa called Yoko, which we are a very happy shareholder of, the fact that us at the growth team, we had seen iZettle and SumUp before, there are some obvious synergy like this. So this is the whole package.
Yeah, that's incredibly interesting to hear, and I'm sure there's a lot of firm builders out there that that found this part interesting. I want to get back to the whole capital efficiency part, and I just want to ask you if you believe that European founders are at risk of overcorrecting with this whole efficiency line of thinking in today's downturn versus the growth at all cost mindset. Do you think that it is that you're seeing founders give up growth to be more capital efficient? Or do you think that we've hit a good balance and we understand it correctly?
I'm not an English speaker, as you can tell by my thick French accent, so I won't have the item correct, but when the tide goes out, you see who swims naked. I think the saying goes. When the capital markets tide goes out, you see who has good unit economics. And so companies that were growing super fast, but which unit economics didn't make sense, when they have to cut costs, growth goes down. But when your unit economics are very sound, and you have 11 months payback on your CACs, on your customer acquisition cost, you do shed some costs here and there if you have to. Growth doesn't decelerate. What we've seen across the portfolio, as a matter of fact, including in one of our star portfolio companies here in France called Scalo, is you cut a bit of costs, growth accelerates. Because it's you just remove some of the fat. So it's really about you have to cut the fat or not, cut the muscle or not. As long as you're in the fat, efficiency is, as I mentioned, high rate of return. It's different from getting from profitability. And so more efficiency, faster growth. This is usually what we see. And look, in the European ecosystem right now, it's true that you have a number of companies that they go for efficiency, meaning they go for breakeven, and now they're stuck in between 0 and 10% growth. And if you are at, whatever your size is, 30, 40, 50, 60 million ARR, if you are in this dead zone of 0 to 15% growth and 0% EBITDA, it's a big, big problem because as an employee, your shares are not worth a lot. Your investors are probably pissed. And as a founder, what do? It's a big problem. This is mistaking profitability and efficiency. The efficient companies, they manage to either be at 15% growth, but 25% EBITDA. There's a market for that, or they manage to have high growth.
Now I want to ask you something else because this is a big topic, so to say. It's about Europe's elite capital allocators and the fact that you have managed to get them into the game. You've brought institutional LPs like Cambridge Associates, StepStone, Hermé, GPE, Legal & General, StepStone, many French insurers and European sovereign funds. I'd love to ask you, what has changed in the last 5 to 10 years to get these allocators off the sidelines?
I think the first thing was to put European tech on the map. When we started in 2015 and we started to pitch growth equity in Europe, people were kind of laughing at us. US, everybody knew. China was hot, but Europe was not even an afterthought. There was not much in terms of growth equity there. The first fundraising was somewhat painful for this. But what have we seen over the years? Now there's a track record of European founders who have proven they can and they want to build world-beating companies. And they've done so again and again. And so now Europe tech is on the map. This is a change, right? For a long time, European founders would settle for 200, 300 million acquisition. And we saw this, by the way, with the EcoVadis founders. When we initially invested, They were like, probably we can settle, in a few years for an acquisition. Okay. So when we did the round where CVC invested, it was mostly fun, but there was a couple of strategic. And at the end of the day, they had the choice. I think this has not been publicized before, so I hope they won't be mad at me. They had the choice between funds or strategic, similar valuation, and they were straight for the fund. They were like, no way we're going to sell. Their own sales 4 years ago would have said something different. And the round with G and Astor, there was not even the strategic in the loop, because now they see the big price. And this is not just EcoVadis. This is a company like Brevo in France, in our portfolio. It's a company like in the UK, Prolific, one of our recent investments, where there was a strategic approach not long ago, and the fund was like, no. We are going to build a world-class business. We're not going to settle. And so I think this resonates with LPs. Now they know that they can be big return for them if they invest in Europe. We have the quality of people. We have now the quantity. Like in 2014, we didn't have the quantity of startups. Now we do. And they know this capital efficiency business, right? Because if you get the same valuation at exit for a US company or European company, but the European company has raised half as much cash, it's better from a return perspective. And so the most sophisticated LPs, some of that you mentioned, this is why they came to us and to other people in Europe, of course. I would say that over the past couple of years, let's say the macro political situation of Europe has not helped. And initially, let's say November to January, when Trump was elected in the US, people were like, wow, man, it's going to be really tough to allocate euros in Europe because America is going to be the dream in terms of the economy and capital allocation. It was extremely funny to see that starting in March, they were like, you know what, let's do Europe. We need to diversify. And so that helps as well. Europe is on the map. It's a healthy diversification versus the US or Asia. China is less and less on the map for a geopolitical concern. The best capital allocators in the world are putting more money on Europe.
Are you seeing, purely because now you called it the asset diversification argument, are you seeing any patriotic movement?
Early days, right? But first, do we start to see some founders, European founders, who are slightly less keen to take US capital versus European capital right now? We start to have a few instances. I wouldn't say it's a trend, but we have a few anecdotes. Interesting. From the LP perspective, we have not seen it at this stage. I mean, of course, sovereign funds, they want to invest in their home country. It was the case before, it's still the case now. But otherwise, no, people are still chasing the best returns. We haven't seen a change quite yet.
Then I have one other question, because you described, there were the movements in the macro political and the economy at large. I'd love to ask you also about this fit of investing in capital efficient companies, because that is, well, one thing is that it can be attributed to Europe, but they exist in the US as well. It's just a very specific strategy, and one which venture normally is not that big on and recognized for. So I'd love to ask you kind of how you think about that, and if that's also where you're seeing a lot of investors resonate better with this than the huge names, but you can at the same time look at, oh my God, it's a lot of money behind that.
Well, absolutely. So look, when I joined Partech 11 years ago, it was called Partech Ventures. Today we're called Partech Partners, and we changed this a few years in because we realized that the growth strategy and today, the impact strategy and others were not really venture, there was something else. And so we should acknowledge this fact. The growth equity category exists in the US in what I mentioned, like often bootstrapped, stuff like this. And when Cambridge Associates typically invests with us, they see in us some of the same patterns they saw in similar GPs in the US. Is it easier for LPs today to invest in our type of product? Yes. LPs, as a rule, are conservative. They don't like downside risk. And our type of investment has a lot less downside risk than venture. And so it's a wider pool of capital to tap in when we come with this brand of growth equity.
I just want to ask one really, really quick question, and it's just because you have been massively successful with the institutional LP, so I think we should just touch on it, but let's not go there for too long because we only have a little bit of time left, and I want to get to Europe's complexity as a feature, not a bug. But I want to ask you really quick, what role do the allocators that you have gotten in want to play beyond capital? Is it co-investment, innovation exposure, or ecosystem building influence, or is it just pure money back?
Different LPs want different things, and I'll be fast as well. Corporate LPs, we have some of them, especially in the earlier stage. They are more interested in exposure to innovation. So this is the first thing. They don't want to lose money, but they want exposure to innovation. And here we can get like some of the top hedge funds in the world who invest in some of our funds because they want to understand what's the next big thing. Okay, that's one. But if you take the regular LP, so the fund of funds, the endowment, the family offices, etc., first and foremost, they're looking for financial return. And one way for them to jack up this financial return is to do co-investment because they do this as zero fees, zero carried. And so they look at the average of doing investment in the fund and with the co-investment to have a better financial return. But they're really focused on this. And that's one of the different sovereign funds. Here they are mostly concerned about making sure that there's some local champions that emerge and more FTEs in their home country in the tech sector.
Okay, now let me go to the European complexity. I'd love to ask you how you see Europe's regulatory and cultural fragmentation actually benefiting startups that go on to become global leaders.
So this one is a bit controversial, right? We can't say that the heavy regulation and the fragmentation of the European market is a positive. But for those companies and those founders who manage to emerge and succeed despite that, it shows a level of strength, combativity that is world-class. And this is why you have companies that start out in 1-2 European countries that can become massive leaders, even if sometimes they start after the US counterparts. It's just because they have some kind of survivor bias. If you manage to survive all of this, it means that you are so strong, you can conquer the world. So this is how we see it. And so when we invest at growth stage, when they are doing 10, 15, 20 million ARR, the quality of the people we see is crazy because to get there, not only they have to be a successful tech founder, which is hard in any geography, but making it in Europe is even harder.
We are 2 minutes from closing. I just want to ask you one question. Partech operates across seed and venture growth, and you're also across Europe, Africa, and also some in the US. I'd love to ask you how you keep your investment thesis cohesive across such diverse geographies and stages. I recognize that you have this family of city-states, so to say, but I'd love to ask you how you make all of this work in the day-to-day. Just a final remark on this.
Yeah. No, I would say there's a culture that binds us, and we are all extremely numbers-driven. So whether you're at seed, at venture, at growth, whatever the geography, we are, most of us are engineers, all of us are price sensitive, all of us are numbers driven. And this makes the dialogue possible because it's not like Mars, Venus, and Jupiter trying to talk to one another.
Beautiful. Omri, I'm so thankful we did this. It was a huge conversation and we had even more prepared. So I think we got to do a round 2 someday, maybe from a mountaintop somewhere. Thank you so much for joining me.
It was a pleasure, Andres. Thank you so much. Bye-bye.
Bye. Before we start the show, a quick note. If you're building or running a fund, it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, SkyTech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to SkyTech this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.